welcome to Hot Commodities. I'm Manisha Gupta, and straight up to the top stories of the day. And before that, wishing all our viewers and guests a very happy new year. Well, the year gone by, the crude oil, base metals, as well as the precious metals have seen immense volatility and a sharp downside. On your screens is the Brent crude oil prices, which have declined 34% in 2015. We also have seen prices decline by 30% for the US crude oil prices. It has been a nearby almost that kind of a decline for the Indian crude oil prices also. So between 30 to 35% is how we have seen the crude oil prices decline. If you look at the natural gas, diesel prices and heating oil, they also have declined between anything 15% to 40% on the higher side. It has been a similar statement when it comes to the gold prices. It has been a third straight year of decline for that. The gold prices have declined by nearly 11%, and it has been a similar kind of a fall coming in for the silver prices. Both the precious metals have been falling for a third straight year. This year as well, there is perhaps pressure expected into the markets there. Everybody from whether it's Deutsche Bank or Goldman Sachs, Morgan Stanley have talked about weaker gold prices. It only has been the HSBC which has talked about strength perhaps in gold prices. They have come out with $1,205 per ounce of an average pricing for gold in 2016. Goldman Sachs, of course, has been talking about 1,000. BNP Paribas, Deutsche Bank talk about sub $1,000 per ounce. And there have been other international banks who think that the prices can go below 1,000 to 955 is what SocGen has come out with. Bank of America Merrill Lynch says $950 per ounce. So it's going to be a year of pressure. Of course, much of the cues would come in from the fact on whether or not you see another Fed rate hike coming in, the strength in US dollar, and whether or not the smart money really moves into Indian equities or global equities. In that sense, of course, gold is something that is not going to be very favorable. Take a look at the outlook for 2016 when it comes to the crude oil prices, and that of course has a lot of varied levels coming in for that one. Goldman Sachs, CLSA and IMF say that prices have not bottomed yet, and you perhaps can see levels as low as $25 to $20 per barrel on the lower side. Much of this, of course, could come in for the first half of 2016. The second half of 2016 can see some support, even buying on the higher side. Morgan Stanley says $49 on the higher side is not ruled out, and you also have SocGen saying that 64 on the higher side as an average price for Brent crude is something that they are looking to achieve. So that's quite a varied view that we have coming in for all of those commodities. Remember, the first quarter of 2016 is when you will see very many of those weightages coming in for the commodity prices and as a sector, and that would tell you on how we move ahead from there on. But for more on commodities, we are now joined by Kishore Narne. He's Associate Director and Head Commodity and Currency at Motilal Oswal. We also have Jayant Manglik, who's President Retail Distribution at Religare Securities. We also have with us Kunal Shah, who's Head Research at Nirmal Bang Commodities. Gentlemen, hi, Happy New Year to all of you. And 2016, as we open up the first day, of course, hasn't seen much of participation coming in. But Kishore, starting with you, what's your sense? How would you sum up 2015 as an year for commodity as an industry?
I think it has its own ups and downs. The biggest change is obviously everybody knows that a merger of FMC with SEBI. I think it's been a long-awaited restructuring which we needed on the regulatory space. I think that's been done. So that's the first step towards major reforms in this industry. I think 2016 comes with a lot more expectations than what has happened previously. Again, we have seen none of the commodities got delisted or those type of things, but actually we've seen something on the Essential Commodities Act, especially in the China, has been a bad experience. So we this year again reiterated that there needs to be a holistic approach from the government and the regulators, that how to incorporate, how to amalgamate these markets into the overall stream of businesses, and bring all the acts together so that things are unified across. So I think that's where some learnings which we have seen in 2016, and obviously it's been a bad year as far as price is gone. most of the commodities have been beaten down to pulp, almost at nearly a decade lows in many of the commodities. Agri commodities have seen their own ups and downs. Guar is one of the most beaten down again. Towards the end, a few commodities like cotton have started to show some signs of pulling back, but most of the other commodities as of now still continue to be under pressure, and there is no fundamental change which is right now visible, though there could be a lot of expectations in the next year.
Well, as you summed it up, Kishore, we have seen a regulatory change coming in for 2015, and of course the commodity prices, as you put it in your language, have been beaten to pulp. Jayant, what's your sense? How would you put 2015 as the year for the industry? The new regulator impact is yet to start showing, because while it has taken over, the SEBI is yet to come out with fine prints. We yet to see the options or the other institutions or even the FIIs to come in for that matter.
Right. So, Manisha, two parts. One, of course, 2015 was an extremely turbulent year for the industry, and in some ways, the bull run which we had in 2006, 7, 8, all of that kind of is 2015, which practically takes care of their entire bull run period. And you see that across commodities, gold, crude, silver, copper, nickel, everything, everything is just crashed. And a lot of people like it, but obviously it's an indicator of economy is not doing well. So overall, it's not such a great story for anybody. On the Indian front, one silver lining has been the merger of FMC into SEBI. I think SEBI has done extremely well with equity over the last couple of decades, and we expect this to happen. The same thing should happen for commodities now. So specifically, I would pick out 2 or 3 things which will get done, I'm pretty sure. One, of course, is the introduction of new products. So whether it is indices, whether it is options, they will get introduced, I'm expecting April or May. But the good part is that all of this is going to lead to volumes and revenue, which is, is down to just 25,000 crores a day now, and I would say that by the end of 2016 we should be hitting, probably exceeding 50,000 crores a day. And the second thing which will help toward volume is the introduction of new participants. So FCRA is out of the window, and SEBI really needs to now simply pick up and say that if all participants can enter this market and make it the healthy market which it is always supposed to be. So, whether it is foreign buyers, sellers, FIIs, Indian mutual funds, banks, all of them should be participating in this market, making it a deep market, and India becomes a commodity hub. So volumes, therefore, by the end of 2016 for me, it should be up extremely high.
Well, that's about the industry on how it was in 2015 and expectations, of course, from the new regulator SEBI for 2016. But let's talk about commodities then, gentlemen. And Jayant, you go first. The crude prices have shut 2015 near 11-year lows. We've seen 30% of a decline coming in. Would you call this a bottom, or, as other international brokerages and banks have been saying, that the first quarter of 2016 could actually see further declines?
So crude oil, of course, has been one of the major themes. It is also a proxy for global growth, and which is why the prices are even more important than any other commodity. And in this 2016, so see, it's fallen like some 30% in 2015 and about 60% over the last 18 months. And if you really look at the demand-supply situation, given the economic backdrop, things don't look good as far as prices are concerned. So which means that demand is low because China is, that is degrowing. The Eurozone is not doing well either. US is the only place where there is demand, there is growth, but they take care of their own demand, so it won't be a factor in the pricing. On the production front, you have all the OPEC countries, which are, there's a market share competition essentially which is going on. So everyone's trying to outproduce the other one. And you also have Iranian crude, which is now going to come into the market in 2016. And in the backdrop of all this, don't forget that the US has also lifted sanctions. They are now allowed to export oil into the global markets, which they will if the prices go up again sufficiently. So prices will remain down, and I would keep a dollar range of about $30 to $50 for this year. Of course, I think it should also be kept in mind that there is a bottom, and it's very difficult to predict the bottom. But a $30 to $50 target for this year is something which I have in mind.
All right, that's the view coming in from Jayant on crude. But Kishore, what's your sense? Do you see $40 as coming back, as holding back as we get into a new year?
I think most of the analysts have miscalculated the strength of shale oil players in the market. A lot of people felt that the marginal cost of production would remain at $40, $45, $50 for shale oil producers in US, and that's where the bottom could have formed. But as it broke, I think there are few insights which it's given. Actually, I've been studying the shale oil producers in depth over the last few months. Especially, they have fighting this storm vigorously, and they're improvising. They have a lot of improvements on the productivity of the wells. They have also reduced costs. Cost rationalizations have been done. If you see the US itself, the production capacity of each well has been increased by around 22 to 30% over the last 6 months to 8 months of time, each well producing output. And on the other side, if you see the PPI for oil producers, the input costs have gone down by roughly around 42% over the last 6 months or so. Even the cost of sand, which is used in fracking, has gone down by 20%. So I think they have been able to push the cost down. Now the marginal cost of production for shale oil in the largest basins will come down close to around $30 to $33. And now if it crude sustains below 30 for a longer term, then probably there could be some implications. Obviously, we have seen rig count coming down. The new wells are not being drilled. So in the next 6 months, the effect of not drilling the new wells will come to show on. So that's pretty much long time right now. But they are weathering the storm quite a bit. And on the other side, the non-OPEC producers like Russia, which has been in terms reduced their cost in domestic cost, because the ruble has been down by nearly 50% in the last couple of years. So the ruble cost of oil producing is down by almost 50%. So whereas their crude in dollar terms is down by 42% over the last 6-7 months. So I think they are also pretty much weathering the storm. So I think the producers are much more equipped to continue to pump more and more oil into the market. I don't see any major supply reduction coming up. So if the demand falters, we might be seeing $20. If the demand continues to show slight growth, because China, India, we are seeing incremental growth in demand coming up. If that shows, probably we are close to 25 to 30 is somewhere what we are looking at in the next 6 months or so.
Well, absolutely. Yes, $25 to $30 per barrel on the lower side, not ruled down in case of crude. But remember, we have seen 3 years of decline for the precious metals. So gold and silver, both the prices have fallen between 10 to 12% for 2015. Kishore, what's your sense? Are you buying gold or silver? Anything between that?
Yeah, I think last month, just about close to Diwali, we came out with a change in our view. We have actually changed our macro view on gold, and a long-term buy report has been released by us. So we have now turned long-term buyers. Short-term, definitely I agree. Short-term, which I mean by, let's say, next six months to 8 months could still be under pressure. But if you're looking at next 2 years, I think we are pretty much in a buy mode right now. Number one reason for that is that if you see the currencies which are depreciating against the dollar, especially the European currency or Japanese, and the kind of stimulus which we are seeing in the expansion of money supply in Europe or UK or Japan will continue to boost the attractiveness of, say, gold for them, number one. Number two, most of the emerging market currencies like India, Taiwan, Korea or Brazil, for that matter Russia, most of these currencies have been beaten down to pulp actually. So in the local currency terms, the gold has been rallying. In ruble terms, gold has rallied more than 50% now, and in Brazilian real terms, it's been rallying. In Chinese currency, it's been rallying in yuan, because the yuan continues to depreciate. So the currency effect of emerging market currencies will continue to improvise demand for gold in these countries. So whatever despite of many attempts, we have not seen a drastic decline in gold demand in India. I think overall we will still be reaching around 850 to 900 tons even this year also. So I think the overall demand will continue to improve and offset the outflows from ETFs. And I believe that probably we have seen the worst out of ETFs, and we could see some demand picking up there also. So I am looking at a long-term bullish perspective, though short-term remains to be slightly pressurized.
That's good to hear that you've turned bullish in for precious metals, but base metals has been an area which has been an underperformer as well. The LME index has declined 24% in previous year. We've seen nickel as an underperformance by 45% for 2015. Jayant, what's your sense? Do you see more downside coming in for base metals, or do you see the fundamentals turning around?
In all this, I would pick up in base metals, copper, and perhaps nickel. So in copper, it's at a 6-year low. I don't see the prices going up significantly from here. But yes, a bottom probably has been reached in rupees. It's about 310 rupees per kg, in that range. So I don't see it going much below 280 or so. But the upside is also limited, because you have, a couple of days ago there was an announcement that Peru will increase its production by some 66%, which converts to about 5% of global output. So at a time when there is less demand from China, from the Eurozone, and globally as a whole, increase in production by 5% at a global level sounds like something which will definitely keep prices capped for the immediate term.
Kishore, what's your sense? Which one are you picking up when it comes to metals? Because lead has declined only 4%, but the other metals have done quite bad in 2015.
I think we will be certainly looking for triggers before we go all out and say buy in metals. But right now, obviously, as you said, that it all depends on China, whether it comes with any kind of major stimulus or any kind of measures which can improve domestic demand in China. Until unless that it's not going to turn around. Number two, on the supply side, if you see, there have been some of the announcement of production cuts in some of the mines, but they're not being very serious or very large quantum of supply going off the market. So until unless we see that pain coming from the supply side or a demand perk up by China, until unless either of these triggers are present in the market, we can't say the turnaround happened. So at this point of time, I think still copper has a long way to go down. Probably we might be looking at even 260, 270 on the lower side in domestic markets. I think nickel is too much beaten down, so it might have lesser downside potential. Aluminum has much lesser room on the lower side. So if I had to be a buyer, probably I'll prefer aluminum to copper, and if I had to be a seller, probably copper is much better attractive at this point of time.
All right, we've noted all of that. So precious metals doing a bit of a turnaround, and there are some favorite picks in the base metal space as well. Gentlemen, stay on with us. We'll take a short break. When we come back, we'll get the best agriculture picks for 2016 after this short. Welcome back. Let's talk about the agriculture commodities as well, and they have had their share of ups and downs in 2015. We are looking at a weaker crop. Weather has been a concern. Kunal, starting with you, take us through the year gone by for the agro space, and what are you picking up from there?
Well, in 2015, we've seen a bit of positive from oilseed complex, pulses complex, and even for that matter, sugar. So most of the soft commodities have done well. Oilseeds and pulses have done well. Rest, even in most of the commodities like rubber, or you take it any other commodities, they have continued to remain bearish. So these three complex have done good in 2015.
They clearly have, yes. And sugar, edible oil, and chana has been an an area that needs to be kept an eye on for 2016 as well. Kishore, what's your sense for the agro pick when it comes to that? Where are you investing, going long or short, either side?
I think the global weather patterns started to show the change. I think in the next couple of months, the El Nino should weaken, and the global weather should gradually pass into a La Nina kind of a situation in the next year. So typically, which would mean obviously that there could be a situation where we can see crops affecting in US rather than in the southern hemisphere of Brazil or Argentina. So probably we can have soybean as a potential crop, number one, and number two, there is a potential of short-term spurt which we have already seen in cotton and which could extend a little bit further. But on the bearish side, I think refined products, oil, like edible oils, will continue to be under pressure because the palm or refined oil, the edible oil will continue to be under pressure. Number one is obviously the crude coming down will disincentivize all the demand for oil on non-edible segments, and at the same time the surplus inventory of oil floating around is also a little bit concern, and probably we feel is palm oil could slightly bottom out towards around 1800 1830 ringgits kind of a levels, where next year the yields will drop in palm, so which could help it to revive some of its growth, some of its price rally. But I think there is a lot of competition among the edible oil players also. A lot of now even Argentina has come out with a zero export duty on edible oil, especially soybean oil. The Malaysia, Indonesia have similar policies, so there could be a dumping ground for oil like China, India. So that could keep the pressure on. So overall, it's a very well tight markets right now. So out and out buyer will be probably you can buy sugar is one thing which I'm looking at as a positive commodity for the next year in agri space, and edible oil space may continue to be under pressure.
All right. Kunal, same question to you. Which are your top agri picks on the long and the short size for 2016 as we enter the new year?
Well, two picks I have. One is in pulses in chana. I expect chana production in India to shoot up by 10 to 15% this season, and the international crops are also very good. So chana prices are likely to remain under pressure. 5,000, 5,100, good levels to go short for the downside target of 4,200 to 4,100 going forward in next 6 months. And on the long side, I think turmeric look very bullish. The carry forward stock of this commodity virtually stands at 3 years, 4 years low. So any shoot up in demand, and I think this commodity is definitely going to go up. The yields are going to be bad this year of this crop, especially from Nizamabad and Warangal and Erode. I believe that this commodity can test levels of 12,000, 12,500 going forward in first half of 2016.
All right, so chana and turmeric are the long picks there. The edible oil can be under pressure as we head into 2016. Final question to you, Jayant. What's your top pick when it comes to the agri space? Do you see Rabi sowing becoming a big concern, or weather for that matter? And is it pulses as well that you also think can see further strength from here on?
So chana prices were, of course, up 50% in 2015 itself. And, I don't see prices going down too much over there because we've had 2 consecutive years of deficient rainfall. Some of it will, of course, depend on how good the production is in the coming year. But currently stocks are low and prices will remain firm. Also, the dollar getting stronger is going to be a factor here. So we are importing a lot of these pulses because of the shortage, and, a stronger dollar will simply make for higher rupee prices. But in all this, just one thing about, exchange accredited warehouses should be removed from the stock control order, because, that just simply makes it easier for the people in the market to manipulate. In an exchange accredited warehouse, everybody knows who owns the stock, how much stock is there, and that should actually be used to bring down prices rather than removing it from that system and pushing it into the informal market where, hoarders and all kinds of people participate.
Well, thank you so much, gentlemen, for your top picks in the agri and the non-agri space for 2016. Hope our viewers have noted all of that. Thank you so much, Kishore, Jayant and Kunal, for coming by and giving us those strategies. With that, that's all the time that we have on the show. Wishing our viewers a very happy new year.